There's no question that this rally has sort of surprised me by strength, especially, let's say, since the middle of December. It's been extraordinarily strong. And I mean, the XAU, I don't know what it is right now, but it's up about 35, 36% since the lows, whether you look at September or October, because we had a double bottom. That's an awfully strong rally. I think two things we need to realize. Gold is still very, very underowned and by investors generally, and gold stocks are still extraordinarily cheap on a long-term basis, despite the rally. So to answer your question, I think in the short term, gold is vulnerable to some kind of hawkish statement or action by the Fed, some unexpected hawkish statement by the Fed. It's interesting that in the December meeting, middle of December, when the minutes were released, the Fed, all the members were almost universally hawkish, trying to out-hawk each other. And they did that in the comments after the meeting. After the meeting, you heard different Fed spokesmen trying to outdo each other with hawkishness about how high rates should go before they paused, and so on. What's interesting to me is that when the minutes came out, gold fell quite sharply and then rebounded very sharply. That's a very strong sign that there's underlying buying. Now, in the last week, we've seen various Fed spokesmen, some expected, some maybe not expected, like Harker from Philadelphia, or Bostic from Atlanta, and the Boston lady, I forget her name right now. But there's been a string of Fed presidents that have come out saying, we should have smaller rate increases now, given the CPI number. We've got inflation coming down, we're winning, and so the conclusion, what I'm saying is that if at the next meeting, at the end of this month, instead of 25, they say, well, let's do one more 50, that will be very devastating for gold. But it doesn't even have to be that. It could just be the comments that Jerome Powell makes after the meeting. But gold is vulnerable, I would say, to the Fed doing something unexpectedly hawkish. Again, I think that would just be short term, and that would be an opportunity to get back on.
Now, I know you've mentioned in one of your recent letters here, insights, is that the mining stocks are incredibly undervalued with respect to the physical bullion. Can you expand on that?
Yeah. If you look back, from 1971, well, let's say from 1975, after that initial run in gold, really all the way to 2007, gold and gold stocks moved pretty much in tandem. Gold stocks would move 3 to 4 times as much up or down as gold bullion, but the line is very, very constant up until 2007, and then you had this great divergence, and gold stocks, particularly since 2011 or 12 when they peaked, have dramatically underperformed bullion, dramatically, and not just by the 3 to 4 that we're used to. There's a lot of reasons for that. One reason, of course, is the popularity of gold bullion ETFs, which make it easy for investors to buy and trade gold itself as opposed to gold stocks. Another one, of course, which we've talked about before, frankly, is just the extreme disappointment of holding gold stocks long term. You look at Barrick and Newmont, and they're still meaningfully under where they were trading in the 1990s and early 2000s. But there's this gap, and the gap has just started in the last sort of 5 months to reverse. And I'm hopeful that over time, we will start to see that gap, close and go back to the historic average, the historic norm. And that's based on gold companies making money. They're making money today. They have free cash flow. They're actually got earnings, which is quite remarkable for gold mining companies. They've got a strong balance sheet. The XAU is net cash positive. Again, extraordinary when you think it's a capital-intensive industry. I don't know how long this financial discipline will last. That's a different question. But for now, the gold stocks are mostly, in aggregate, in a very, very strong position. So I expect to see outperformance of the gold stocks.